Interest is obviously going to be a big part of your house payment, right? Assuming you borrow money to purchase a home, you're going to have to pay some interest. Y'all, part of your payment is the principal, which obviously the principal amount's what goes towards paying down the debt. But then you also have to pay interest, which is what the penalty for borrowing the money, I guess you might call it. But anyway, so you have to pay interest typically. But there's different types of interest that you need to be aware of, and you certainly need to understand what we're about to go over here. But the first type of interest is that paid in advance. We've talked about that a few times already. That's the discount points, where you can actually buy points to buy down your interest rate. That's what we call interest paid in advance, because in essence, when you buy discount points, it's just prepaid interest in advance. And because you're paying that interest up front, they'll agree to lower your interest rate. But then there's also this interest that's paid in arrears. So, if you borrow money, let's say today is June the 10th, and we close today on our brand new home, June the 10th. When will your first payment be due? Well, here's what you got to keep in mind. There has to be a minimum of 30 days from the time you close until the first payment can be due. Okay? There's got to be 30 days in between. Well, the due date's always going to be the first of the month. Okay? Well, if we go to July 1st and we close today on June 10th, with July 1st, would that be 30 days between closing and July 1st? No. So we'd have to kick it to the next month. So actually my first payment would be due on August the 1st. Okay? And here's why that matters. When you make that payment on August the 1st, obviously that will include some principal, the amount going towards the debt, but it will also include interest on the loan. But the interest you're paying on August the 1st will be the interest you owed from July the 1st through the end of July. All right? That's what they call interest paid in arrears. So every time you make a payment, the interest portion of it is for the previous 30 days that you owe. Okay? It's not for the current month, it's for the previous month or 30 days. So that's what we call interest paid in arrears. So again, when we made that payment on August the 1st, we know that pays the interest from July 1st through the end of July. Now, we need to back up a little bit, because remember, we closed on June the 10th. Well, what about the interest from June the 10th through the end of June? What kind of interest is that? That's what we call interim interest. So when do you pay the interim interest? That has to be paid at closing. That will be part of the buyer's closing cost. So this is just one of these closing costs that even if you're getting 100% financing, you're going to have some amount of money to close, okay? Because there are other closing costs other than just the down payment. So even if you don't have a down payment, there's still some other closing costs, and this is one of them. You're going to have to pay interim interest on that money. And again, that's the interest you owe from the time you close through the end of the month that you closed in. So how do we, and by the way, you're going to have to be able to calculate interim interest. You need to do this, you need to know how to do this anyway when you're working with buyers when you're out there practicing. But you're certainly going to have to know how to calculate interim interest for the exam. So let's talk about that. So how do we figure out how much interim interest is going to be due? Well, we got to figure out, well, how many days are there from June the 10th through the end of the month. Now, before you start doing too much math and calculating here, here's something you need to understand. It depends on how you go about prorating or how you're told to prorate. Because y'all, they could tell you to prorate based on a 360-day year, or potentially they could tell you to prorate based on a 365-day year. Well, what's the difference? Well, if they tell you to use a 360-day year, then you must assume there are 30 days in every month. Now, y'all, obviously we know not every month has exactly 30 days. Some's got 31, some's got might even have 29 or 28. But y'all, not every month has 30 days. But based on a 360-day year, then we're going to prorate based on the assumption there are 30 days in every month. If they should tell you to use a 365-day year, y'all, then that means now you will have to prorate based on exactly however many days there are in that particular month. So if you don't know how many days are in each month, you might want to look at your calendar a little bit. However, I'd be surprised if they told you to use a 365-day year. The attorneys will use a 360-day year, and that's what we're going to prorate and base this interim interest on. We're going with a 360-day year. It's just a lot easier math. It's the calculations are a lot easier this way. And this is what most attorneys will use, a 360-day year. But if for some reason they tell you in the question to use a 365-day year, then just know that you need to know exactly how many days are in that particular month. So we're going with 360, so we know we're assuming there are 30 days in the month. So how many days are there from June the 10th through the end of the month? And keep this in mind. You must always count the day of closing. So if you count the day of closing, that should give you 21 days, right? So now you know how many days you owe in interim interest. So how do we calculate how this would work? Okay. Actually, I've got an example, and in fact, my example is going to change some of what I just talked about. But let's look at this, y'all. In this example, using again the 360-day year. First of all, you have to know, well, how much interest am I paying annually, per year when I have this loan? And the way you would do that is you just take whatever the loan amount is times the interest rate. In this example, we have a $200,000 loan with a 7% interest rate. So all you got to do now, to figure out your annual interest is just multiply the loan amount. 200,000 times 7% would give you $14,000. So just so you know, it means you're going to be paying $14,000 per year just in interest. None of that goes towards paying down the loan. That's just the interest portion that you're paying. But then, but now I know how much it is per year, but now I need to know how much is it per day. Well, how many days per year are we using? Remember, 360. So you take that 14,000 divided by 360 days, and we know the interest is $38.89. We may have rounded that 89 a little bit. But it's $38.89 per day. That's what we owe in interest. So to figure out the interim interest, just take the $38.89 times however many days there are between the closing date and the end of the month. And in this example, it says we're closing on June the 12th. Okay. So, and again, must always count the day of closing. So that would give you 19 days. So if I take the $38.89 per day times 19 days, that's where we come up with $738.91. Again, that 91 may be rounded, but there's your interim interest, and when does that $738.91 have to be paid? At closing. That will be part of your closing cost. And at the end of this chapter, there's some practice questions for you, and you'll have some more of this to do, just to practice with. But make sure you will have to calculate interim interest on the exam. Okay, so you need to know how to do that for sure. But hopefully you won't have any problems there because it's not very difficult. All right, the next thing we need to take, or another type of interest we need to take a look at is the fixed rate. Obviously, that would be the one I would probably prefer. Just say fixed rate, fixed interest rate for the life of the loan. I mean, it's not going to change. It's going to stay whatever you agree to from start to finish. There are some loans that you could get the adjustable rate mortgage, or ARM, you hear it referred to as. And typically what they're doing here, and the reason people might like the ARM is because at least initially, the interest rate that you're going to get up front is usually lower than what you would typically see if you got a fixed rate mortgage. So you could get a lower interest rate with the adjustable rate mortgage. However, you only get to keep that lower rate for some period of time, and it's typically a fairly short period of time in relation to the life of the loan. But at some point, your interest rate will begin to adjust. That's why they call it an adjustable rate. It could potentially go up. It could potentially go down. It just depends on what the market's doing at that time, right? But how long could you expect to keep the low rate before it begins to adjust? Again, that varies. That's something you need to talk to your lender about. But sometimes it might be as little as maybe 3 years, maybe even 10 years. I don't know, but probably right around 5 years, give or take. A year or two is probably what you're looking at, but then it starts to adjust. And typically you can about count on it going up. Okay. So that means your payment is getting ready to go up, and it could go way up depending on what the interest is doing at that time. Okay. So if you're going to do an adjustable rate mortgage, I'd be very careful with that. I certainly would. Especially if you got the loan and the payments are pretty much at the max that you can pay. The last thing you need to do is for it to eventually go up, and now you're having to add another $500 or $600 on top of your monthly payment. Now you really got a problem. All right, but then the last of the interest here is called the annual percentage rate, or APR. I would encourage you to pay attention to that, not just for test purposes, but if you're ever getting a loan, most borrowers, the first thing they typically want to know from the lender is how much is the interest rate? What's the interest rates right now? And I will tell you, obviously it matters. I'm not trying to say the interest rate doesn't matter. But, in the big scheme of things, that's not what you really need to pay the most attention to when you're borrowing money. In fact, I would suggest to you, don't ever ask how much the interest rate is. Because I believe, in my mind, I believe this. You ask the loan officer about the interest rate, which that's what almost everybody does. In that loan officer's mind, they're thinking, oh yeah, I got another one. Yep, this is going to be easy. Because at the end of the day, our interest rate's negotiable. To some degree, they are. I'm not going to get into all the details about it, but that interest rate could be a little bit negotiable depending on other terms with the loan. And y'all, what I want to know is not the interest rate. I want to know what's the annual percentage rate. Y'all, the APR. Y'all, the APR, y'all, it is a number expressed as a percentage, very similar to the interest rate, but your APR will also be a percentage, y'all, or a rate. But what that percentage is telling you is how much it's going to cost you per year to borrow this money. That's what I would pay attention to. So the APR will have calculated into that rate all the cost, which would include interest. Y'all, obviously interest is just one of potentially many different costs of borrowing this money. So the APR obviously is what you want to pay attention to. Y'all, just for example, y'all, let's say the interest rate is 7%, and your APR is 7.5%. Because y'all, your APR has to be at least equal to the interest rate, because y'all, it has to include the interest, right? So your APR will always be at least equal to the interest. It's typically some amount over whatever the interest rate is. But y'all, if I'm paying 7% interest and the APR is 7.5%, y'all, then you know it's going to cost you 7.5% per year of the loan amount to get this loan. So it's not just the interest that you need to worry about, y'all. It's the other cost associated with that loan. Because y'all, in some cases, y'all, the lender might say, well, we can loan you the money at 6.5%, which is 0.5% less than the other lender doing 7%. And I'm telling you, pretty much 100% of borrowers say, yep, I'll take that loan. They got the cheaper interest rate. The problem is, and what you didn't pay attention to, their APR might be 8%. Yeah, they agreed to lower the interest rate to 6.5%. But the APR is 8%. So that means it's costing you 8% of the loan amount per year to borrow the money. Where you could have gone with the loan, even though it's 7% interest, the APR is only 7.5%. Y'all, I would rather pay all interest and none of the fees. Y'all, because typically mortgage interest is tax deductible, right? Y'all, these other fees are not. So just because you've got a low interest rate does not mean you have the best loan. In fact, it may mean you've got the more expensive loan. But they kind of suckered you into it by making you think you got this wonderful loan with this low interest rate, and they're eating you alive in fees. So y'all, the number you need to pay attention to is the annual percentage rate. That's what you need to pay attention to. All right. Now we need to talk a little bit about your escrow. Y'all, I think we touched on it a little bit in an earlier module. But y'all, most borrowers, not everybody's required to do this, but lenders will require probably most borrowers to have an escrow account. Y'all, this is where this PITI payment comes into play. If you recall, I'm talking about PITI, which stands for principal, interest. Y'all, because you know you got to pay some principal and interest, but it also includes taxes and insurance. And y'all, what the lender is typically, y'all, what they're doing is, y'all, they're requiring you to pay, y'all, a month at the time, whatever your taxes on the property would be, and whatever your homeowner's insurance would be. Okay, so if they know your annual taxes are, I'm making up numbers, but if the annual taxes are $1,200, then y'all, if you divide that by 12, that'd be $100 a month. So they would tack that $100 a month onto your house payment, right? Same thing with your homeowner's insurance. And then when they collect your payment, y'all, they pull whatever amount of taxes and insurance that, out of your payment and put it in an escrow account. Y'all, this is your money that the lender is collecting for you. Now, this is a very good idea for most people, because y'all, now at the end of the year, when the county sends out their tax bill, now obviously you'll get a copy of it so you can see what your taxes are, but they'll also send the tax bill to your lender, and then your lender will pay your property taxes out of your escrow account. And the same thing with your insurance company. Y'all, the lender will pay your homeowner's insurance out of your escrow account. So you're not paying a large lump sum for taxes and insurance each, at the end of the year. The lender's actually paying it for you because they've collected it 1 month at the time throughout the year that's now sitting in your escrow account. Okay? Now, when it comes to these escrow accounts, and again, this could be part of, this is going to be part of your closing cost, okay? Typically the lender's going to want you to put up a certain amount of money to go into your escrow account, basically to get it started. And, and this is not for every loan, okay, or every lender, but typically they're going to require you to have 14 months of taxes and insurance up front, just to start your escrow account. They want to make sure that when the tax bill comes due or the insurance bill comes due, that there's going to be plenty of money in that escrow account to pay it. So you're going to have to pay whatever 14 months of taxes and insurance would be. Some may go 12 months perhaps, but I think 14 is probably more common. That will be paid at closing. That's another closing cost. So for these home buyers that think, well, I'm getting 100% financing so that I don't have to have any money at closing, you're going to have problems, because you're going to need money at closing. So here's one more closing cost. In addition to the interim interest we just talked about earlier, you're going to have to establish that escrow account. Now, the good news is, once you sell or pay off the loan, or if you sell your house, obviously, and then pay off the loan, all that money that is sitting in your escrow account, you're going to get a check back from the lender for all that money. Because, it's your money. It's yours. It doesn't belong to the lender. It's your money. But the lender just wants to make sure these taxes and insurance are paid. Okay? All right. In fact, and on this slide here is talking about the risk of non-payment. This is why the lender might require the escrow, because they're concerned, if you don't pay those taxes, then the government can come and take the property, and that kind of messes up that lender's collateral if they don't get their money. Same thing with the if you don't pay your insurance, and God forbid the house burned down, and now there's no insurance to replace it, that leaves the lender in a very vulnerable situation. So there's a lot of risk here to the lender if these things aren't paid. That's why they would likely require the escrow account. And then the last thing that could also affect your escrow account is potentially flood insurance. Obviously, if you buy a house in a flood zone, that's considered a very high risk area. It could potentially flood. Most insurance policies, your basic homeowner's insurance does not cover flood damage. So the lenders will be checking to make sure that the home you're buying is hopefully not in a flood zone. But if it is in a flood zone, before they loan you the money, they're going to make sure we have flood insurance. These programs are administered by FEMA, but that's going to add quite a bit each month to your premium. Flood insurance is not cheap. So that is absolutely something that could, again, make your payment go up. So these are things you certainly need to be aware of and just be ready to deal with it.